What's up, guys? In today's video, I'm going to explain exactly how you can buy life insurance in a corporation in Canada. So with that, let's get started. Okay, so why would you even want to buy life insurance in a corporation in the first place? Well, if you're a Canadian citizen and you're a Canadian business owner and you have a corporation, well, then you're going to understand that the taxes that you pay on earned income in a corporation are substantially lower had you taken that money out personally. Now, depending on how much you're taking out personally, maybe it's roughly the same, but you'd have to take a relatively low amount to have it equal the same. Most people have an average tax rate of maybe 30 to 40%. I mean, this is just an average. It's not your particular situation. It's just an average here. Whereas the corporate tax rate for the small business deduction is anywhere from 10 to 13%, 10 to 15%. So it's substantially lower. So the main reason why you'd want to buy life insurance in your corporation is, of course, the lower tax rate, because you're paying for it with after-tax profits. So instead of paying 30 cents to fund it, now you're only paying 10 to 15 cents to fund it on the dollar, of course, okay? So that's the main reason why you'd want to have it in a corporation. So how does it actually work, having insurance in a corporation? Well, there's three different components to an insurance policy. There's the owner, there's the payer, and there's the beneficiary. And to make sure that you set it up correctly, you want to have the corporation as the owner of the policy, the payer of the policy, and the beneficiary of the policy. You don't want to make you as the shareholder the beneficiary of the policy, because you'll run into what's known as a shareholder benefit issue, where you can have all the life insurance proceeds taxed, and you don't want to have that. That's a big no-no. So don't set it up that way. You want to make sure the corporation is the owner, payer, and beneficiary of the policy. So now you're probably thinking, well, that doesn't make sense. If I pass away, now this money goes into the corporation. How does my family get that? How does my spouse get that? That doesn't make any sense. Do they have to pay tax when they take that money out? Like, this doesn't really make sense. I'm gonna explain how that works, okay? The one thing that you need to know about life insurance in a corporation is this little equation right here. And hopefully I'll put this on screen for you, okay? The face amount, which is the amount of life insurance that you purchase, okay? So if it's $1 million, let's just say that. So $1 million, the face amount minus the adjusted cost basis of the policy, okay, equals the capital dividend account, or the CDA. Okay? Now, the ACB, or the adjusted cost basis of an insurance policy, is a little bit complicated of a mechanism. However, all you need to know is that as you pay premiums into a policy, the ACB is going to go up. And as you get older, there's something known as the net cost of pure insurance, which actually drives that ACB down. So as you get older, it'll start lowering that. And as you stop paying premiums, it'll also start lowering that, okay? I hope that isn't too confusing to you. I should note, though, that the ACB is only on permanent life insurance, okay? On term life insurance, there's no ACB. So exactly your face amount minus your ACB, which is 0, equals your CDA. Now you're probably thinking, what the hell is CDA, or capital dividend account, okay? Well, the CDA is essentially a notional account in which you can pay tax-free dividends out to other shareholders. So let me give you an example here to make this clear as mud, so you understand exactly how this works, okay? Let's say there's a husband and wife, and they're 50-50 shareholders in a company. And let's say that the husband gets $1 million Term 20 product on himself through the corporation. The corporation is the owner, payer, and beneficiary of the policy, okay? Well, let's say, unfortunately, the husband passes away, in which case the $1 million then gets paid to the corporation, all right? Because this was a term product, there's no adjusted cost basis of this. So the face amount, which is $1 million, minus 0 equals the CDA. So there's $1 million then of capital dividend account balance that's now in this corporation. And so this amount can be paid 100% tax-free out to the wife. So there is a mechanism that allows you to flow out the life insurance to the deceased estate 100% tax-free. Okay, I hope that's clear as mud. The last thing that I want to talk to you about is two different considerations for permanent life insurance. Now, I talked a little bit about term life insurance, and I talked a little bit about permanent life insurance. I will absolutely make a video, term life insurance versus personal life insurance. If it's not already right there, it will be there soon, so don't worry. But the one thing that you need to consider if you are placing permanent life insurance in a corporation, there's two considerations you need to be very careful of. The first consideration, if you intend to shut down this company or sell it or move it, you don't want to put permanent life insurance there. The reason being is there's a lot of tax consequences that can happen when you move a permanent life insurance policy from one corporation either to another or to the individual. So you want to be very careful that if your plans are to eventually get rid of this corporation, either by selling it or by passing it down somehow or by just dissolving it, you want to make sure that the insurance is not placed there, okay? The second thing that you want to be very careful of is I mentioned that if you sell it, it's not a good place to put the permanent life insurance. There's something known as the capital gains exemption, and I don't want to get too complicated in this video. All it is there's a possibility that when you sell your company, you don't have to pay any tax on it, and I'll probably make another video about that somewhere here. However, if you have permanent life insurance in that corporation, there's a good chance that you do not qualify for this benefit. So those are two reasons why you might not want to put permanent life insurance policy in a corporation. I hope this video helped. If you have any questions, please reach out. And if you're enjoying this content, just give me a thumbs up. I will see you guys in the next one.